DSCR loan rates and conventional mortgage rates both jumped 8 basis points this week, with the 30-year fixed climbing from 6.44% to 6.52%. Inflation just came in hotter than expected, and the Fed's path to rate cuts got a lot narrower overnight. Here's what that means for every rental property investor watching this market right now. Stay until the end. I'm going to reveal exactly how selecting the right property type can slash your DSCR loan rate by 25 to 50 basis points, even when inflation keeps rates stuck in the mid-sixes.
The inflation gut punch. Why the Fed just hit the pause button on rate cuts.
On Tuesday, May 12th, the Bureau of Labor Statistics dropped the April CPI report, and the bond market did not like what it saw. Headline inflation came in at 3.8% year over year, with a 0.6% monthly gain. Core CPI, which strips out food and energy, jumped 0.4% in a single month, double March's reading. That's the kind of number that makes Fed officials break out in a cold sweat. Here's what happened in the bond market immediately after. Traders who had been pricing in near-term rate cuts started unwinding those bets. When expectations for Fed cuts get dialed back, Treasury yields climb, mortgage-backed securities follow, and the 30-year fixed mortgage rate rises right along with them. That's exactly the transmission mechanism we saw play out this week. Hotter inflation data directly translated into higher borrowing costs, pushing rates back toward the top of the mid-6% range.
The shelter trap. How your renters are keeping mortgage rates elevated.
Here's the detail from the CPI report that doesn't get enough attention. The shelter index rose 0.6% in a single month and is up 3.3% year over year. Shelter is the single largest component of core CPI, and it's running persistently hot. The Fed cannot declare victory on inflation while rent and housing costs are accelerating, which means the higher for longer policy stance isn't going anywhere fast. There's a real irony here for rental property investors. Strong rent growth, the exact dynamic that makes your DSCR deals cash flow, is simultaneously one of the forces keeping your financing costs elevated. Shelter inflation keeps the Fed cautious. The Fed cautious keeps Treasury yields elevated, and elevated yields keep DSCR loan rates anchored in the mid to upper sixes. Understanding that connection is the difference between investors who get surprised by rate movements and those who see them coming.
The rate update. The major economic indicators and how they're affecting your wallet.
30-year fixed mortgage rate started at 6.44% to ended at 6.52%. DSCR loan rates are typically 0.75% above conventional mortgage rates, putting them in the 7.19% to 7.27% range this week. Rates touched a 6-week high of approximately 6.57% midweek before pulling back slightly to close at 6.52%. So volatility is very much in play. Initial jobless claims came in at 200,000 for the week ending May 2nd, up 10,000 from the prior week's 190,000, but still historically low. A labor market this resilient gives the Fed no urgency to cut rates, which is exactly why mortgage rates aren't moving lower. A job market this tight is actually a tailwind for rental demand, but a headwind for financing costs. ADP, private employment. Private employers added 109,000 jobs in April, modestly above consensus. Combined with the CPI data, this paints a picture of an economy running warm enough that the Fed has every reason to stay on hold, and lenders have every reason to keep DSCR underwriting conservative.
Your move. Wait for lower rates or build a process to capture the dips.
Here's the honest read on this market. The fundamental data: 3.8% inflation, a 200,000 claim labor market, sticky shelter costs, says the Fed is not on the verge of meaningful rate cuts. The baseline for DSCR loan rates is mid to upper sixes, and that's where you need to underwrite your deals. But here's the nuance that separates investors who get deals done from those who keep waiting. This week's volatility also shows that geopolitical headlines, specifically developments around the Iran conflict and US-China diplomatic signals are injecting real day-to-day swings of 10 to 20 basis points into the mortgage market. Rates touched 6.57% and then pulled back to 6.52% in the same week. That kind of intraday movement creates execution windows. The smart play isn't to gamble on a rate forecast, it's to set a rate lock trigger in advance. Identify the rate at which your deal pencils well. Build your LOI and term sheet process tight enough to close fast and lock the moment that window opens. Don't re-underwrite, don't hesitate. The window may only last a day.
Now let me unpack the strategy I promised you. Choose lower risk property types. Not all assets priced the same in DSCR programs. Single-family homes typically receive materially better rates than condos, 2 to 4 unit properties, or non-standard assets. In a market where DSCR loan rates are anchored in the mid to upper sixes, steering towards single-family rentals can mean the difference between a 7.50% rate and a 7.00% rate on the exact same loan amount. And that spread compounds into thousands of dollars over the life of the loan. If you want to explore which property types give you the best rate positioning for your specific portfolio strategy, call or text me directly. Our info is in the description below, and I'll walk you through exactly how to structure your next deal for the best possible pricing.
If you want to learn how to use financing to grow your portfolio, check out my DSCR Loan Tips and Tricks playlist. Inside, you'll find powerful strategies, lender insights, and real-world tips to help you close more deals and maximize your cash flow.